week. Let's welcome in now our first headliner of the day. He is Ricky Sandler. He is the founder, CEO, and CIO of Eminence Capital. Welcome back. It's good to see you again.
It's good to see you too, Scott.
Appreciate you.
That's right, I can see you.
Well, I could see you. I hope you can hear me.
I can hear you,
and hopefully we'll get this figured out. Ricky, it's been a while, right? You were last with us in March. OK,
yep.
You told us then you weren't as bullish as you were the prior year. You said clearly some parts of the market are extended and overvalued and that you're seeing some signs of behavior that is less healthy. As I said, entering this segment here, we're basically at record highs. How do you see the market today?
Well, I see the market as still constructive from a high level. I think when you look at where interest rates are, when you look at negative real interest rates that are close to 1%, an economy that still looks generally healthy broadly, it's hard to be too negative. I'd say we're still slightly leaning constructively and slightly longer than average, but not exuberant. I think below the surface, you're going to start to see a lot more dispersion. We're later in the cycle, later in the economic cycle. You're starting to see a lot more earnings-related pressure starting to build. Fiscal cliff is coming. So I think consumer-related pressures, particularly at the low end, are going to start to build. You're going to start to see a lot more pressures in the margins of companies. So up and down the P&L, wage pressures, supply chain pressures, pressures on materials costs. Tax rates are going to go up next year. You certainly have a Biden administration that seems to be a lot less business friendly. So we think there'll be a lot more dispersion and maybe market sort of grinds a little higher here, but maybe a good environment for stock pickers.
It's interesting. I have your newest letter right in front of me. It's dated from yesterday, and you list a lot of the risks that you just laid out for all of our viewers, but you do counter those with a number of positives. You've got still the cheap cost of capital. We still have to fully reopen. The consumer's very strong. Companies have pricing power. And there's still a lot of cheap businesses out there. My question to you is, do all of those positives carry enough weight to outweigh the risks?
I think at a broad level, I think they do, and maybe just moderately. And so I think that's why we still have a slightly above average exposure. And I wouldn't be sort of ringing alarm bells that I want to kind of jump off the train and get negative on stocks here. When I look at negative real interest rates of -1. If you look at inflation expectations at the 10-year level, they're 2.6%, and we have a 10-year bond at 1.66. At a 5-year level, they're 2.8%. So you get negative returns if you invest in bonds. Why not invest in companies that offer you pricing power and reasonable earnings yields? So I think stocks are still kind of the place to be. But as I said, you got to be more selective, and there's going to be earnings-related pressures, and we have a number of risks as I laid out before. So
if inflation is a principal risk, and I'm sure you heard what Paul Tudor Jones had to say on the network yesterday. I had David Einhorn with me yesterday, Carl Icahn the other day. Talked a lot about the inflationary pressures that are out there. You say in your letter you're expecting more volatility, but not a dramatic decline. So are you less worried about the inflation issue as some of the others that you've probably heard on the network this week?
No, I'm very worried about the inflation picture, and I think we are dealing with it in a couple of ways. One is narrowing the list of companies that we own, making sure we own sort of good businesses we think that will be able to price for the inflation, and where we think they'll be able to either pass their costs on or where they don't really have inflationary pressures in their business. And then we're short some businesses where we think they may not have those same benefits, and we're also short some fixed income and the treasury market as a natural hedge against where I think stocks are valued off of the risk-free rate here.